Welcome back to our series on investing for retirement. In this video, we're going to talk about asset allocation in some more detail. I'm going to explain what asset allocation means. We're going to build off of our previous videos where we talked about objectives for retirement, income investing, as well as how to identify how much risk you need to take in your investment portfolio. Now we're going to talk about how you build those different asset classes or allocate those assets inside of your retirement investment portfolio to make sure that it does the job that you need it to do for you in retirement. If we haven't met yet, my name is Mark Walhout. I run an investment advisory and financial planning business called Walhout Financial. I help people with retirement, and I created this channel to share ideas and concepts that I'm using to help people with retirement every single day. If you want to get more videos like these, consider subscribing to the channel and click the like button if you like this video. And make sure that you hit that bell icon when you subscribe so that you're alerted when new videos are posted. So I'm going to go ahead and jump into the content for this week. And a really quick recap from last week, we talked about how to address the question, how much risk do I need to take in my investment portfolio? You really need to measure three things. Number one, it's your ability to take risk. Number two, it's your willingness to take risk. And then finally, it's your need to take risk. And now we're going to talk about how those different mixes of asset classes look kind of in a investment portfolio to see sort of those trade-offs in action. We talked about the different asset classes, their historical return characteristics, but now we're going to look at what they look like blended together so that you can get a better sense of what I'm describing. So I'm going to go ahead and I'm going to share my screen. And I've put together a chart showing a number or four different portfolio mixes of equities and fixed income. And very quickly, you can identify what really separates these or sets them apart from each other. And we start with an allocation that has 20% in equities or global stocks and 80% in fixed income. That's that lower or the lower line here. And the annualized return from 1994 through to this year, so just under 30 years, is about 5.56% per year. And we go all the way up to a portfolio of 80% equities and 20% fixed income. And the annualized return going back to 1994 is about 8.56% per year. So really what we're doing is just illustrating those trade-offs. If you want to aim for higher return, if you have the ability, willingness, and need to aim for higher return in your retirement investing portfolio, you can do that by allocating more to equities, but you also need to be mindful that that trade-off comes with a cost, and that is that at these higher equity allocations, you can expect there to be significantly higher levels of volatility. And as we progress through the series, we're going to look at how to measure the impact of that additional volatility on the retirement income plan and retirement investing plan. But today, just wanted to reinforce that major trade-off. The more risk that you are taking in the investment portfolio, the more you can expect that volatility if you're aiming for that higher return that goes along with taking that higher risk. And so now we're going to talk about the way that we fill those buckets in our portfolio. So we've talked broadly about equities, we've talked about fixed income and cash. Those are really the three major asset classes. Alternatives, we're going to spend some time talking about in this series as well. But now, how do we go about selecting the actual securities that go into the portfolio? And this is where I see a lot of people start to get nervous and maybe head down paths that they may not want to or need to in the pursuit of building the perfect retirement portfolio. And a lot of news media and a lot of advisors, frankly, will have retirees believe that the key to a successful retirement income portfolio is selecting the most successful or the highest performing mutual funds, ETFs, changing them from year to year, month to month, knowing what's going to happen in the market and be able to adjust the portfolio accordingly, get out of the market when the market's potentially about to crash, or jump back into the market when they think that the market's about to take off. And the good news is that sometime around the mid 20th century, around the 1960s, before that time, we actually didn't know what made for a really good portfolio. It was a lot of just guesswork done by investment managers. But around that mid 20th century, 1960s, we actually had financial experts and financial economists and researchers and academics actually looking at the performance of securities as well as funds. And they started to draw a number of very important conclusions. They were able to identify what actually made for a good portfolio and what in the long run actually drives returns in diversified portfolios. And I'm going to go ahead and we're going to share the screen again. I'm going to talk you through some of that. But I've got a number of images here at the bottom. These are some of these academics that I'm talking about. So on the left, you have Harry Markowitz, who passed away sadly earlier this year. Then you have Bill Sharp, Eugene Fama, and Kenneth French. And their research into the historical behavior of security prices and the performance of diversified portfolios tells us that about 90% of the return differences between different diversified investment portfolios can simply be explained by asset allocation. How much exposure that portfolio had to equities versus fixed income, and also different types of equities inside of that portfolio. So small cap stocks versus large cap stocks, and cheap stocks, value stocks versus growth or expensive stocks. So once you sort for exposure to those different risk factors inside of a portfolio, we're able to explain about 90% of the differences in return between diversified portfolios. And what does that really mean when it comes to a retirement investor or someone who's building that portfolio? Is that if you kind of look over the lifespan of your retirement portfolio, we're talking about maybe a 20 or 30 year time horizon. Most of the story of your investment returns is not going to be, did you pick the perfect fund? Did you time the market perfectly? It's going to be how much exposure did you have to these known risk factors? Again, it's stocks versus bonds, as we saw in the previous chart. Higher equity allocations, historically speaking, over long periods of time tend to outperform lower equity allocations. And how much exposure did you have to these other risk factors? Small cap stocks versus large cap stocks, and relatively cheap stocks versus relatively expensive stocks. Now, I'm kind of dropping some breadcrumbs here for the rest of the series. If you kind of look forward to the end of the series, I'm going to spend some time talking about more advanced strategies. But the point of today is to show you how these different asset allocations work in practice, the trade-offs between risk and return over the long pull, and the predominant or the dominant force that simply your asset allocation has in the determining what your overall return is going to be over the life of your retirement portfolio. It's not going to be, did you pick the perfect fund? Did you time the market perfectly? It's how much exposure did you have to a diversified portfolio of stocks versus bonds? And did you simply just stay put and keep things fairly simple? And that's generally my philosophy around building investment portfolios. Now, the next question is, what types of asset classes should we be including in the portfolio? And the short answer is all of them. And I'm going to show you a chart. And this is another one of my favorites whenever I'm doing education for people around how to build a portfolio. And on the left-hand side, what you'll see here is different asset classes. So Canadian fixed income, Canadian stocks, large stocks, value stocks, small cap stocks. Same for US, international. And we also have some real estate in there. So we're showing different asset classes that we would presumably want to include in our portfolio. And then the chart at the top shows the ranking of each of these different asset classes from highest annual return to lowest annual return going back to 2008. And the thing that I want you to, or maybe is already jumping out at you, or the big takeaway is that performance from year to year in each of these different asset classes is highly random. It changes a lot. You can see the different colors in the sort of quilt or the asset allocation quilt here. But really the big takeaway is that each of these asset classes we expect to have positive performance, but they go through periods where they underperform. They have positive years and negative years. And the degree to which they perform relative to each other changes a lot on a year-to-year basis. And so generally my encouragement to people that are building portfolios is that we don't know which of these asset classes is going to outperform and when. So generally we want to have as much exposure to each of them as possible when we're building the portfolio. The only dials that we want to turn are simply how much exposure do we have to equities versus exposure to fixed income. But then within those sub-asset classes, we want to have exposure to Canadian stocks, US stocks, international stocks. And then furthermore, again, we're going to talk more about it later in the series, within those asset classes, specific types of securities that kind of move independently from one another, which is small cap stocks, value stocks, even potentially some real estate investment trusts. And then on the fixed income side, there are some different things that we want to target there as well. And again, we're talking about some additional ideas for later in the series that I'm going to talk about. And so we're going to go and we'll close on this video because we've talked for a while now about asset allocation. We split that almost into two videos: ability, willingness, need, and now how the asset classes perform. We know that the key driver of investment returns over long periods of time is just that asset allocation. It's not some of those more, I guess, traditional things that maybe we come to our mind when we think of being a successful investor. It's getting that perfect pick or choosing that best manager or getting in and out of the market at the right time. And then we've demonstrated that there's a really important element to just getting all those asset classes together in the portfolio to make sure that we're exposed to each of them when they do outperform, because we know that that performance can be quite variable from year to year. So that's the video on asset allocation. Now we're going to go back to our agenda and we're going to talk about what we've covered so far. So we've talked about our objectives. We've talked about the ability, willingness, and need to take risk. And we've talked about asset allocation. Now we're going to talk a little bit more about some tactical things that we want to think about when we are building out these portfolios for retirement. I'm going to introduce a very simple 2-bucket system. And it might surprise you. You might have heard of the bucket system before. The bucket system I'm going to talk about is probably different than what you're thinking about, but I think it's a very useful way to approach this retirement portfolio decision. We're going to talk about the importance of stress testing your portfolio. We're going to talk about actively managed funds versus passive funds, big mistakes, the things that I see people making, and then we're going to close the series with some more discussion on advanced strategies. So I hope that you found this to be a helpful video and appreciate you watching to the end. If you have any questions or comments, leave them below. I love getting your questions. They give me good ideas for future videos. And if you like this video, give it a thumbs up. And I hope that you're having a fantastic day and have a great weekend. Take care.